Advanced Taxation. Chapter 3. Tax Planning and Incentives. Content 1. Purpose 2. Tax Planning 3. Tax Avoidance 4. Tax Avoidance and Evasion 5. Tax Incentives 6. Benefits and criticisms of tax incentives 7. Other tax planning issues 8. Chapter review 9. Worked examples. Tax planning and incentives. Purpose. After studying this chapter, readers should be able to understand tax planning, understand tax avoidance, be able to distinguish between tax avoidance and tax evasion, understand the nature and scope of engagement letter to tax consultants and corresponding letters of acceptance by tax consultants, identify client documents to be kept and maintained by tax practitioners, identify records to be kept by taxpayers, understand the nature and information required for registration of taxpayers with the tax authorities, give suitable replies to tax queries, and communicate effectively with other stakeholders on client tax matters. Tax planning. The main taxes in Nigeria can be classified into direct and indirect taxes as follows. Direct taxes. These are charged on a taxpayer's income, profits, or other gains. They are paid by the taxpayer directly to the tax authority. The direct taxes are personal income tax payable by individuals, companies' income tax payable by companies other than those engaged in petroleum operations. Petroleum profit tax is payable by companies engaged in petroleum operations. Education tax is payable by companies, whilst capital gain tax is payable by both individuals and corporate bodies. Indirect taxes. Indirect taxes are taxes imposed on commodities, that is goods, professional services, and instruments before they reach the ultimate consumer, clients or owner respectively, and are paid by them, not as taxes, that is, not to the tax authorities, but as part of the selling or legalization price or cost of the commodity, service or instrument, as the case may be. Examples of indirect taxes include value-added tax, custom duties, excise duties, and stamp duties. A simple guide to determining what tax is indirect. A simple guide to determining what tax is indirect is to acknowledge the fact that once the tax burden is not borne directly by the entity that remits the tax to the relevant tax authority, then it is an indirect tax. Direct taxes. Direct taxes are personal income tax, company income tax, petroleum profit tax, education tax, capital gain tax, property or estate tax. Indirect taxes are value-added tax and custom and excise duties. Tax planning involves taking conscious efforts to consider the tax that will be payable by a taxpayer at a future date and how such tax can be minimized. It is clear that payment of tax is an outgoing from the viewpoint It is clear that payment of tax is an outgoing from the viewpoint of a taxpayer. With respect to profit or income tax, the amount that can be retained by the taxpayer from the profit or income of his business or investment is reduced by the amount of tax that such payer has to pay. Payment of tax in any country is regulated by the laws of each country. It is a statutory obligation that everyone has to comply with. Stiff penalties, including imprisonment terms, are usually in place in the tax legislation of each country to ensure that the taxes are paid. Since legally and morally there may not be any way out other than to pay the tax stipulated by the law of the country. It has been the consensus from the days of old that taxpayers are not under any obligation to pay more tax than is necessary. Consequently, taxpayers have resorted to devising several means of ensuring that they pay the minimum possible tax. Tax planning involves anticipating a set of circumstances and the identification of opportunities to minimize or defer tax liabilities within the law. It involves arranging affairs to ensure that the maximum allowances, exemptions, and reliefs are enjoyed. Consideration will be given to the likely effect on the tax liabilities of the timing of fixed asset acquisitions and disposals. The choice of the accounting date of a business entity can also have a significant effect on the tax payable by that business. The impact of the commencement rule in the tax legislation on the taxable profit of the taxpayer ought to be considered in tax planning before deciding on the taxpayer accounting date. Planning with regards to the time that the profit is earned and the timing of the payment of the applicable tax on such profit could result in significant financial advantage to a continuing business. When a business ceases to trade permanently, the date of cessation can also impact the amount of its tax liability. In tax planning, the tax-conscious business person and the expert tax advisor working together can very often significantly reduce the tax liability that would be otherwise payable. Tax planning requires detailed knowledge of tax legislation and its application to particular circumstances, identifying and taking advantage of loopholes, if any. It should also be noted that tax planning involves taking note of the applicable taxation legislation to ensure that the tax laws are properly complied with by taxpayers, such that all taxes due are paid as at when due. Tax planning checklist. The matters in the underlisted checklist should be considered while planning tax. A. List of approved taxes and levies. B. Timing of fixed asset acquisition. C. Timing of fixed asset disposals in view of balancing adjustments. D. Timing of capital allowances claim and amounts to claim. E. Hire of assets as alternative to outright purchase. Full hire charge is tax deductible. F. Where to invest. G. Making specific instead of general provisions. H. Payee properly deducted. I. Withholding tax properly deducted. J. Note critical dates such as filing of tax returns, filing of notice of objection, payee monthly remittance, payee year-end returns and final payment, withholding tax remittances to revenue, VAT returns and remittances to revenue, National Social Insurance Trust Fund (NSITF), National Housing Fund (NHF). K. In capital gain tax, that is CGT, consider rollover relief. CGT rate is 10%. Stocks and shares now exempted from CGT. Invest in stock and shares rather than in buildings. M. Consider current tax incentives. Pioneer companies, rural investment allowance, investment tax credit, export processing zone allowance, export free zone exempt profit of solid mineral mining, investment tax credit, spare parts fabrication, investment tax credit, replacement of obsolete plants, gas industry incentives. N. Consider exempt income and profits. O. Investment options, low or no tax investment opportunities. P. Dividend distribution out of flagged investment income. Q. Employees' remuneration. Consider the effect of benefits in kind on taxable remuneration. Tax avoidance. Tax avoidance arises in a situation where the taxpayer arranges his financial affairs in a form that would make him pay the least possible amount of tax. For example, avoidance of value-added tax can be achieved by anyone that does not buy the goods and/or services on which VAT is levied, far from boycotting the goods or services. Tax avoidance schemes are carried out after a critical review of the tax laws. The taxpayer would then implement devices to exploit loopholes in the tax laws that would enable him avoid or minimize tax. It should be noted that to a very large extent, tax avoidance is legal once it is done within the limits permissible by the tax laws. The dictum established by the Lord President, that is Lord Clyde, in the case I. Shree Pullman Motor Services and David M. Ritchie and CIR several years ago still holds today. The Lord President's statement is reproduced as follows: no man in his country is under the smallest obligation, moral or otherwise, so to arrange his legal relation to his business or to his property as to enable the Inland Revenue to put the largest possible shovel into his stores. The Inland Revenue is not slow, and quite rightly, to take every advantage which is open to it under the taxing statute for the purpose of depleting the taxpayer's pocket. And the taxpayer is in like manner entitled to be astute to prevent, so far as he honestly can, the depletion of his means by the revenue. In the Federal Revenue Service of Inland Revenue and American International Insurance Company, Nigerian PLC, Begor CJ stated, tax is an obligation, not a duty. One is not a bad citizen if one can organize his business or trade in a legal manner to minimize his tax liability. He could and he should resist within legal means any unduly wide interpretation or unconventional implication of legislative intent of a tax law that might increase that burden. He can do so without being ashamed of walking in the streets as a patriotic citizen. A shrewd business acumen and a legitimate protection of sweat of labor are not dishonest acts or an act having any moral turpitude. It is being pragmatic and practical. Being capitalistic might leave much to be desired, but among what is left is not illegality. When tax avoidance schemes are stretched to the limit, taxations would be seen only in mere form and lacking in substance. This will be because such transactions were entered into just for tax avoidance purposes. There may be no commercial effect. When this signal is present, the Revenue Service would want to step in to disallow such transactions. To the extent that no tax law would be contravened in several tax avoidance schemes, tax avoidance is legal. This is clear from the opinions of the court as reproduced earlier. When loopholes in tax legislation have been exploited for tax avoidance purposes, certainly the laws would not have been broken. High rate of tax could make the cost of elaborate avoidance schemes worthwhile. This will support the view that the existence of widespread tax avoidance is evidence that the tax system requires radical reform. The possible reaction of the Revenue Service to where loopholes in the tax legislation that have been exploited is to take steps to block the loopholes. Thus, specific legislation will be passed to block particular loopholes or loophole. Such is referred to as specific anti-avoidance legislation. With one loophole blocked, the taxpayer would search out other loopholes and exploit them. There are therefore bound to be several and unending specific anti-avoidance legislation to effectively stop the taxpayer willing to carry out tax avoidance schemes. As the legislation cannot accurately foresee all schemes which the determined taxpayer could devise, consideration will be given to the promulgation of general anti-avoidance legislation. Anti-avoidance legislation. The two possible forms of anti-avoidance legislation are A. Specific legislation to block known tax avoidance devices, and B. General anti-avoidance legislation which vests the revenue with power to disregard all transactions entered into that could be proved to have been entered into solely for tax avoidance purposes. The following are some advantages and disadvantages of this. A. Specific anti-avoidance. 1. Advantages. It provides advantages. Its provisions make the law imposing tax on a particular transaction clear and certain in its application. Ineffective or inadequate legislation can be readily amended. 2. Disadvantages. May make an already complex legislation more complicated and less comprehensible to taxpayer, detracting from the simplicity canon of taxation. The taxpayer would seek further loopholes and again exploit such for further tax avoidance, which may create an unending need for further legislation. B. General anti-avoidance. 1. Advantages. The number of anti-avoidance legislation is reduced, consequently minimizing the complexity of the tax law. Provisions exist in the tax legislation to discourage all further tax avoidance, that is, schemes that are considered to have violated the spirit of the tax laws. 2. Disadvantages. Provisions are general, vague, and could lack precision. Too much reliance is placed on discretion of tax officials for its application. The tax officials could exceed the intention of the legislation in certain respects or fail to carry out in full in some others. In the United Kingdom, specific anti-avoidance legislation exists that gives their tax authorities the power to set aside certain tax avoidance schemes. Tax avoidance schemes that could be cancelled are: 1. Where there existed a preordained scheme involving a number of steps aimed at tax avoidance, or 2. Where steps are inserted for tax purpose without a commercial or business purpose, regardless of whether they have a business effect. The taxpayer will have a defense if he can show that. 3. The transaction or transactions were carried out either for bona fide commercial reasons or in the ordinary course of business. And 4. None of the transactions had as their main object or one of their main objects the obtaining of a tax advantage. Introduction of general anti-avoidance rules have been considered in the UK. The conclusion was that general anti-avoidance rules might be the way forward. Such have to be drafted so that there is no infringement on the rights of taxpayers and that normal commercial transactions are not jeopardized in the process. It was reported that general anti-avoidance rules have been tried in Australia, New Zealand, and Canada with little success. This could further strengthen the view that specific legislation may be more desirable. In Nigeria, besides few specific anti-avoidance provisions scattered throughout the Tax Act, CETA Section 18 contains the general anti-avoidance provision regarding companies' taxation. Similar provisions are contained in PITA Section 17 and PPTA Section 13 relating to personal taxation and petroleum profit taxation, respectively. CETA Section 18. Where the Revenue Service is of the opinion that any disposition is not in fact given effect to, or that any transaction which reduces or would reduce the amount of any tax payable is artificial or fictitious, it may disregard any such disposition or direct that such adjustments be made in respect of tax liability as it considers appropriate, so as to counteract the reduction of tax liability which would otherwise be affected by the transaction, and any company concerned shall be assessed accordingly. Transactions between persons, one of whom either has control over the other, or, in the case of individuals who are related to each other, or between persons, both of whom are controlled by some other person, shall be deemed to be artificial or fictitious. If, in the opinion of the Revenue Service, those transactions have not been made on terms which might fairly have been expected to have been made by persons engaged in the same or similar activities, dealing with one another at arm's length, a company in respect of which any direction is made under this section shall have a right of appeal in like manner as though such direction were an assessment. The whole idea of this provision is that where any disposition is not in fact given effect to, the consequence of which is that a tax liability which should normally arise from such disposition did not arise. The Revenue Service would want to step in. This provision is intended to cover cases where the purported transaction, if recognized as valid, would enable the taxpayer to avoid payment of income tax on that which is truly is taxable income. The transactions would be considered as artificial, that is, not genuine or fictitious. When these situations are established, the tax authority may disregard such disposition. In the alternative, the authority may direct that such adjustment shall be made in respect of the income of an individual or an executor or a trustee, as the authority consider appropriate, so as to counteract the reduction of liability to tax effected or reduction which would otherwise be effected by the transaction. Summaries of 2 UK cases are quoted below for further illustration. Ramsey Limited and IRS, 1981. The taxpayer had implemented an elaborate tax avoidance scheme with the sole purpose of reducing a liability to CGT by creating allowable losses. The House of Lords held that although every transaction in the scheme was genuine, they were self-cancelling and the court should look at the effect of the transaction, which was to avoid tax. The scheme as a whole produced neither gain nor loss and so should be disregarded for tax purposes. Fumis and Dawson, 1984. The Ramsey principle was extended in this case beyond the self-cancelling transactions. A scheme would also be rejected where steps in the transactions are inserted that have no commercial purpose other than to avoid tax. Subtopic: Tax avoidance and tax evasion. Although tax avoidance is not an offense, the Revenue Service has power to set aside tax avoidance schemes that result in artificial or fictitious transactions. Taxpayers carrying out tax avoidance scheme will not be subject to criminal prosecutions. Contrariwise, tax evasion is illegal. Tax evasion is the act whereby the taxpayer can achieve the minimization of tax through illegal means. Tax evasion involves outright fraud and deceit. For example, through deliberate omission of a source of the taxpayer's income from his return or deliberate understatement of any income. In Nigeria, tax evasion on a large scale is through failure to render tax returns. Tax evasion may be achieved by A. Understating income, B. Overstating expenditure, C. Making false claims for allowances and reliefs, and D. Omission from tax return or chargeable income. Tax evasion is usually more prevalent when the tax system is perceived to be unfair. Lack of transparency in governance may also encourage tax evasion. The Revenue Service views any case of tax evasion seriously. If discovered, the Revenue Service will go further to reopen the relevant assessment beyond the normal statutory limit of 6 years. A tax evader may be charged to court for criminal offences, with the consequent fines, penalties, and at times imprisonment. However, unless the amount involved is large and the taxpayer is unwilling to cooperate, the Revenue Service will usually resort to out-of-court settlement with a lump sum payment by the taxpayer in settlement of the tax and penalty that would have been lost if the evasion was not discovered. Tax avoidance and tax evasion can be compared as follows. Tax avoidance, tax evasion. Tax avoidance is legal, tax evasion is illegal. Tax avoidance is achievable through exploiting loopholes in the tax laws, incorrect returns. Tax evasion is achievable through deliberate action of fraud and deceit or rendering. Tax avoidance results in taxpayer paying minimum tax possible without breaking the law. Tax evasion results in taxpayer not paying correct tax or paying minimum tax through the breaking of the tax laws. Tax avoidance is supported by the court in decided cases. Tax evasion has no support by the court. Tax avoidance is not a criminal liability. Tax evasion is when tax evader could be charged to court for criminal offences with the consequent fines, penalties, and at times imprisonment. For tax avoidance, when stretched to the extreme, the scheme could be discouraged. Tax evasion. At any level, Revenue Service will frown at tax evasion. Tax avoidance. No Revenue Service investigation. Prior year assessment will not be opened. For tax evasion, Revenue Service investigation will be instituted. Revenue Service has the power to open prior assessments beyond the statutory 6-year limit. Subtopic: tax incentives. Tax incentive is a reduction by government in the payment so as to attract that person or company to invest in a country. Tax incentives are therefore in the tax laws to A. attract, retain, or increase investment in a particular sector. B. assist companies or individuals carrying on identified activities. C. assist business carrying on identified activities. The incentives may be granted on industry basis or on the type and may include exemption from payment of taxes, reduction in rate of tax to be paid, grants of allowances, and deduction from profits subject to tax, etc. Subtopic: industrial sector taxation. Fiscal measures have been drawn to provide for deductions and allowances in the determination of taxable income of manufacturing enterprise, including pioneer status, which is a concession to pioneer companies located in economically disadvantaged areas, providing a tax holiday period of 3 to 5 years. These industries must be considered by the government to be beneficial to the country's economy and in the interest of the public. Companies that are involved in local raw material development, local value added, labor-intensive processing, export-oriented activities, implant training, are also qualified for additional concessions. Tax relief for research and development, R&D. Up to 120% of expenses on R&D are tax deductible, provided that such R&D activities are carried out in Nigeria and are connected with businesses to which allowances are granted. The result of such research could be patented and protected in accordance with internationally accepted industrial property rights. Local raw materials utilization. 30% tax concession for 5 years to industries that attain minimum local raw material utilization as follows. Agro, 80%. Agro-allied, 70%. Engineering, 65%. Chemical, 60%. Petrochemical, 70%. Labor-intensive mode of production. 15% tax concession for 5 years. The rate is graduated in such a way that an industry employing 1,000 persons or more will enjoy 15% tax concession, while an industry employing 100 will enjoy only 6%, while those employing 200 will enjoy 7%, and so on. Local value added. 10% tax concession for 5 years. This applies essentially to engineering industries, while some finished imported products serve as inputs. This is aimed at encouraging local fabrication rather than the mere assembly of completely knocked down parts. In-plant training. 2% tax concession for 5 years of the cost of the facilities for training. Export-oriented industries. 10% tax concession for 5 years. This concession will apply to industries that export not less than 6% of their products. Infrastructure. 20% of the cost of providing basic infrastructure such as road, water, electricity, where they do not exist, is tax deductible once and for all. Investments in economically disadvantaged areas. 100% tax holiday for 7 years, an additional 5% depreciation over and above the initial capital depreciation. Excise duty. Excise duty is defined by the Excise Ordinance number 64 of 1941 as any duty other than export duty of customs imposed on any goods manufactured in Nigeria. Excise duty is the money paid to the government by manufacturing concerns for goods produced. It is a production tax. It was abolished with effect from 1 January 1999, but was immediately reintroduced the following year. Goods liable to excise duty are beer and stout, wines, spirits, cigarettes and tobaccos that are manufactured and sold in Nigeria. Import duty rebate. A 25% import duty rebate was introduced in 1995 to ameliorate the adverse effects of inflation and to ensure increase in capacity utilization in the manufacturing sector. Investors are, however, advised to ascertain the current operative figure at the time of making an investment, because these concessions have undergone some amendments in the past few years. Reinvestment allowance. This incentive is given to manufacturing companies that incur capital expenditure for purposes of approved expansion of production capacity, modernization of production facilities, diversification into related products, it is aimed at encouraging reinvestment of profits. Investment Tax Allowance. Under this scheme, a company would enjoy generous tax allowance in respect of qualifying capital expenditure incurred within 5 years from the date of the approval of the project. Dividends derived from manufacturing companies in petrochemical and liquefied natural gas subsector are exempt from tax. Companies with turnover of less than 1 million naira are taxed at a low rate of 20% for the first 5 years of operation if they are into manufacturing. Dividend from companies in manufacturing sector with turnover of less than 100 million is tax-free for the first 5 years of their operation. Investment guarantee or effective protection. Subtopic: investment guarantees or effective protection. Transferability of funds. Section 24 of NIPC Decree provides that a foreign investor in an enterprise shall be guaranteed unconditional transferability of funds through an authorized dealer in freely convertible currency of A. Dividends of profits, that is net of taxes attributable to the investment. B. Payment in respect of loan servicing where a foreign loan has been obtained. C. Remittance of proceeds, that is net of all taxes and other obligations in the event of a sale or liquidation of the enterprise. Or D. Any interest attributable to the investment. Subtopic: guarantees against expropriation. By the provision of Section 25 of the same NIPC Decree, no enterprise shall be nationalized or expropriated by any government of the Federation, unless the acquisition is in the national interest or for the public purpose, and no person who owns either wholly or in part the capital of any enterprise shall be compelled by law to surrender his interest in the capital to any other person. This can only be done under a law that makes provision for A. Payment of fair and adequate compensation, and B. Right of access to the court by the determination of the investor's interest or right and the amount of compensation to which he is entitled. In addition to all these safeguards, the Nigerian government is prepared to enter into investment protection agreements with foreign enterprises wishing to invest in Nigeria. Access to land. Any company incorporated in Nigeria is allowed to have access to land, right to the purpose of its activity in any state in the country. Any access to land. Subtopic: access to land. Any company incorporated in Nigeria is allowed to have access to land rights for the purpose of its activity in any state in the country. It is, however, a requirement that industrial companies comply with regulations on use of land for industrial purposes and with environmental regulations. Land lease is usually for a term of 99 years unless the company stipulates a shorter duration. Tax waiver on bonds. Company income tax, exemption of bond, and company short-term government guarantee. Order 2011. The following are exempt from company income tax for 10 years effective from 2 January 2012. A. Short-term federal government securities such as treasury bill and promissory notes. B. Bond issued by federal, state, and local governments and their agencies. C. Bonds issued by corporate and supranationals. And D. Interest earned by holders of bonds and securities listed above. Subtopic: Public Infrastructure and Employment Relief. Company Income Tax Exemption of Profit Order 2012. The commencement date is 27 April 2012 and will last for 5 years subject to the specific conditions under each incentive. A. Public Infrastructure Incentive. 30% of the cost of infrastructure of a public nature will be granted as a tax-deductible expense. To qualify, the infrastructure should be completed and available to public use, except where impracticable or an exemption is obtained from the Ministry of Finance. B. Employing Generation Incentive. Tax deduction of the lower of 5% of accessible profits or new employee salaries can be claimed. To qualify, a company must have a minimum net employment of 10 staff in assessment period. At least 60% of the net employment should relate to new graduates. C. Staff Retention Incentive. Tax deduction of 5% of accessible profit is available. To qualify, a company must have a minimum net employment of 5 and must have retained the employees for at least 2 years from the year of assessment when they were first employed. Net employment means the difference between incoming and outgoing employees of the company in an assessment period. Subtopic: Incentives to ECOWAS country, that is ECOWAS Trade Liberalization Scheme, ETLC. Approved products manufactured by beneficiaries of the ETLC are allowed free access to markets within the ECOWAS region without any import duties in the destination countries. Products approved for the scheme must satisfy the rules of origin, which require at least 60% local raw materials content or volume, or 40% local raw material value monetary, or a minimum of 35 local value added, that is 35% local value added. The costs, insurance and freight CIF value of imported raw material must not exceed 60% of the total cost of raw materials used. ETLC is not fully operational going by the low level of implementation by member countries. Subtopic: Oil and Gas Sector. The following fiscal incentives have been approved by the government in the gas production phase. A. Tax rate under Petroleum Profit Tax (PPT) Act to be at the same rate as company tax, which is currently at 30%. B. Capital allowance of the rate of 20% per annum in the first 4 years, 19% in the 5th year, and the remaining 1% in the books. C. Investment tax credits at the current rate of 5%. D. Royalty at the rate of 7% onshore and 5% offshore. Gas transmission and distribution. A. Capital allowance as in production phase. B. Tax rates as in production phase. C. Tax holiday under pioneer status. LNG project. A. Applicable tax rate under PPT is 45%. B. Capital allowance is 33% per annum on site straight line basis in the first 3 years, with 1% remaining in the books. C. Investment tax credit of 10%. D. Royalty of 7% onshore, 5% offshore, tax deductible. Gas exploitation, that is upstream operations. A. All investments necessary for separate oil from gas. All investment necessary to separate oil from gas from the reserves into suitable product is considered part of the oil field development. B. Capital investment facilities to deliver associated gas in usable form at utilization or transfer point will be treated for fiscal purposes as part of the capital investment for oil development. C. Capital allowances, operating expenses, and basis for assessment will be subjected to the provision of the PPT Act and the revised Memorandum of Understanding (MOU). Gas utilization downstream operations. Incentives for encouragement of exploitation and utilization of associated gas for commercial purpose include: A. An initial tax-free period of 3 years, renewable for an additional 2 years. B. 15% investment capital allowance, which shall not reduce the value of the asset. C. All fiscal incentives under the gas utilization downstream operation in 1997 are to be extended to industrial projects that use gas in power plants, gas to liquid plants, fertilizer plants, and gas distribution or transmission plants. D. The initial tax holiday is to extend from 3 to 5 years. E. Gas is transferred at 0% PPT and 0% royalty. F. Investment capital allowance is increased from 5% to 15%. G. Interest on loans for gas projects is to be tax deductible provided that prior approval was obtained from the Federal Ministry of Finance before taking the loan. H. All dividends distributed during the tax holiday shall not be taxed. Subtopic: oil and gas free zone. Incentives and fiscal measures approved by the government that favor and encourage large investment in the region include: A. No personal income tax. B. 100% repatriation of capital and profit. C. No foreign exchange regulation. D. No free shipment inspection of goods imported into the free zone. E. No expatriate quota. F. Initial tax holidays period has been extended from 3 to 5 years and renewable for another 2 years. G. Investment capital allowance has been increased from 5% to 15%. H. All dividends distributed during the tax holiday shall be tax-free, etc. Petroleum industry. Very similar generous incentives packages was granted the joint venture system and is contained in the MOU signed with oil companies. Agriculture. Without prejudice to government deregulation of the financial sector, banks have been enjoined to recognize the difference in the gestation periods within each category of agricultural loans, ranging from 6 months to 10 years, for crops, livestock, fisheries, forestries, and wildlife. In addition, the following incentives are also available. A. Companies in the agro-allied business do not have their capital allowance restricted to 60%, but graduated in full 100%. B. Agro-allied plants and equipment enjoy enhanced capital allowance of up to 50%. Solid minerals. Nigeria is richly endowed with a variety of solid minerals of various categories, ranging from precious metals, stones, and industrial minerals such as barite, gypsum, kaolin, and marble. The Ministry of Solid Minerals has worked out a package of attractive incentives for potential investors in the solid mineral sector, including A. 3 to 5 years tax holiday, B. Deferred royalty payments depending on the magnitude of the investment and strategic nature of the project, C. Possible capitalization of expenditure on exploration and survey, D. Provision of 100% foreign ownership of mining companies, or consent, E. In addition to rollover relief under the capital gain tax, companies replacing their plant and machinery are to enjoy a once and for all 95% capital allowance in the first year with 5% retention value until the asset is disposed of, etc. Tourism. The tourism sector was accorded preferred sector status in 1991. This makes it qualify for such incentive as tax holidays, longer years of moratorium, and import duty exemption on tourism-related equipment. State governments are prepared to facilitate acquisition of land through the issuance of certificate of occupancy for the purpose of tourism development. 25% of income derived from tourists by hotels in convertible currencies are tax exempt, provided such income is put in a reserve fund to be utilized within 5 years for expansion or the construction of new hotels, conference centers, etc. that are useful for tourism development. Energy sector. All areas of investment in this sector are considered to be pioneer products or industry. As a result, there is a tax holiday of 5 to 7 years for investment in the sector. There has been a deregulation of this sector, resulting in the emergence of independent power producers, IPP, that will soon start operation in Nigeria. Telecommunication. Government provides non-fiscal incentives to private investors in addition to a tariff structure that ensures that investors recover their investment over a reasonable period of time, bearing in mind the need for differential tariffs between urban and rural areas. Rebates and tax relief are provided for the local manufacture of telecommunication equipment and provision of telecommunication services. Subtopic: tax incentives for other lines of trade. Companies' profits in respect of goods exported from Nigeria are exempt from tax provided the proceeds are expatriated to Nigeria and used exclusively for the purchase of raw materials, plant equipment, and spare parts. Profits of companies whose supplies are exclusively input to the manufacturing of products for export are excluded from tax. All new industrial undertakings, including foreign companies and individuals operating in an export processing zone, are allowed full tax holiday for 3 consecutive years. As a means of encouraging industrial technology, companies and other organizations that engage in research and development activities for commercialization are to enjoy 20% investment tax credit on their qualifying expenditure. All companies engaged only in the fabrication of tools, spare parts, and simple machinery for local consumption and export are to enjoy 25% investment tax credit on their qualifying capital expenditure, while any taxpayer who purchases local manufactured plants and machinery are similarly entitled to 15% investment tax credit on such fixed assets bought for use. Subtopic: Export incentives for non-oil sectors. Export proceeds. Export proceeds can be retained in foreign currency in a domiciliary account with any authorized bank in Nigeria. Special Export Development Fund. A special export development fund has been set up by the government to provide financial assistance to private sector exporting companies to cover a part of their initial expenses in some export promotion activities, including training courses, symposia, seminars, and workshops, export market research, advertising, and publicity campaign in foreign markets, trade missions, etc. Export Adjustment Fund. There is also an Export Adjustment Fund scheme which serves as supplementary export subsidy to compensate exporters for the high cost of local production arising mainly from infrastructural deficiencies and other negative factors beyond the control of the exporter. Export Processing Zones, EPZ, Export Processing Zones, EPZ reliefs. There are zones designated to grant incentives to export-oriented companies, mostly in the manufacturing sector. The following are industries permissible: oil and gas logistics, electrical and electronic products, textile products, garments, wood products and handcrafts, leather products, petroleum products, rubber and plastic products, cosmetics and other chemical products, metal products and machinery, educational materials and sports equipment, printing materials, communication and office equipment, medical kits, optical instruments and appliances, biscuits, confectionaries and other food processing, pharmaceutical products, ship building and repairs. Proposals for industries outside the above listings will be considered on their individual merits. Locating in any free zone in Nigeria automatically confers upon the investor certain advantages, benefits, and incentives which have been strategically designed by the federal government of Nigeria to create a business-friendly environment for the investor and to be competitive. These incentives, established by Act number 63 of 1992, and which have been improved even more in subsequent legislation, are the following: A. Complete holiday from all federal, state, and local government taxes, rates, and levies. B. Duty-free importation of capital goods, machinery or components, spare parts, raw materials, and consumable items in the zones. C. 100% foreign ownership of investment. D. 100% repatriation of capital, profits and dividends. E. Waiver of all imports and export licenses. F. Waiver on all expatriate quotas. G. One-stop approval for permits, operating license and importation papers. H. Permission to sell 100% of goods into the domestic market. However, when selling into the domestic market, applicable custom duties on imported raw material shall apply. I. For prohibited items in the custom territory, free zone goods are allowed for sale, provided such goods meet the requirement of up to 35% domestic value addition. J. Waiver on all expatriate quota for companies operating in the zone. K. Minimize delay in the movement of goods and services. L. Rent free land during the first 6 months of construction for government-owned zones. Subtopic: Benefits and criticism of tax incentives. Benefits. There are some benefits derived from tax incentives, even though it is said to play a minor role in influencing investment decisions into country. Some of them are: A. Tax incentives can be used to attract investment into the country as an indication to the reluctant foreigner that he is needed, welcomed, and would be well treated. B. It is a convenient tool to attract industries that will help to solve unemployment. C. It improves the commercial profitability of investment by making available tax-free income within the tax holiday period, which are reinvested in assist and the establishment of other industries. D. It also serves to establish a favorable investment climate and provide the desired assurance against confiscation and against non-convertibility, especially in developing countries, including Nigeria, where there are different problems with currency restrictions, instability of government, and the risk that foreign capital investment may be expropriated, etc. E. Tax incentives help in drawing attention to the profit prospect of investing in certain types of business that a country seeks to promote. F. It is also necessary so as to compete with the international capital market. G. It also increases the profit prospect of a new venture and enable a firm to recover its capital cost faster, so that the risk of investment are reduced considerably. Having looked at some beneficial aspects of tax incentive, we will now look at some criticism that have leveled against it. Criticism of tax incentives. A. It has been criticized on the ground that most tax incentive laws are new and empirical studies of their operation are so scanty. Thus, it is not possible to present a definite appraisal of their contribution to new investment, and it is not possible to measure the cost of tax incentive measure against benefits received. B. It is criticized as being as ineffective and inefficient stimulants to investment, especially in developing countries, as it complicates the regular company or business tax legislation and tax shelters made available to taxpayers through all sorts of means, is a veritable source of tax avoidance and or evasion for a smart taxpayer who may take advantage of the yawning loopholes that may result therefrom. C. It has also been criticized on the ground that if a tax system believes in the sanctity of endless provision of shelters, there will be no end to the erosion of the statutory tax base of such a tax system. According to Seyi Ojo, this is made worse by the government sacrificing its tax revenue on the altar of political gains. D. It has been criticized that the resultant proliferation of tax holiday and the keen competition among developing countries, especially in offering tax incentive for new incentives, has to a great extent diluted its promotional value. E. The grant of tax incentive has been criticized because it is said to be disproportionate as the benefits derived therefrom firm to firm, and as such firms that are more profitable will likely enjoy more benefits than those with little or no profit. That has been countered by Seyi Ojo, who said that if the most profitable business enjoys more benefits, there is nothing wrong, as it should encourage other firms to work hard towards being profitable, which will enhance the nation's wealth. F. It is also said that such large benefits through highly profitable business will result in a serious loss of revenue to the government, which is almost short of revenue. It has in fact been reported by Adetone Phillips that the cumulative effect of the incentives provided in Nigeria between 1958 and 1966 was a loss of revenue equivalent to 4% of the total revenue of government. Section 3.6 Other tax planning issues. Thin capitalization. A company is said to be thinly capitalized when its capital is made up of a much greater proportion of debt than equity, that is, its gearing or leverage is too high. This is perceived to create problems for two classes of people. A. Creditors, being the solvency risk of the company, which has to repay the bulk of its capital with interest, and B. Tax authorities, who are concerned about abuse by excessive interest deductions. Credit risk. If the shareholders have introduced only a nominal amount of paid-up share capital, then the company has lower financial reserves with which to meet its obligations. If all or most of the company's capital come from debt, which needs to be serviced and ultimately repaid. It means that the provider of capital are ultimately competing with the company's trade creditors for the same capital resources. At the risk of generalizing, most traditionally common law countries do not tend to employ thin capitalization rules, generally in relation to raising and maintenance of capital. However, a number of civil law jurisdictions do. However, in almost all jurisdictions, there are certain types of regulated entity which requires a certain amount or a certain proportion of paid-up share capital to be licensed to trade. The most common example of this are banks and insurance companies. This is because if such companies were to fail and go into liquidation, the economic effect of such failure can lead to a domino effect, which can have catastrophic consequences for other businesses and ultimately regional economies. Tax issues. Even where countries' corporate laws permit companies to be thinly capitalized, tax authorities in those countries will often limit the amount that a company can claim as a tax deduction on interest, particularly when it receives loan at non-commercial rates, e.g. from connected parties. However, some countries simply disallow interest deduction above a certain level from all sources when the company is considered to be highly geared under applicable tax regulations. Some tax authorities limit the applicability of thin capitalization rules to corporate groups with foreign entities to avoid tax leakage to other jurisdictions. The United States earnings stripping rules are an example. Hong Kong protects tax revenue by prohibiting payers from claiming tax deduction for interest paid to foreign entities, thus eliminating the possibility of using thin capitalization to shift income to a lower tax jurisdiction. Tax haven. Introduction. A tax haven is a state, country, or territory where certain taxes are levied at a low rate or not at all. Individuals or corporate entities can find it attractive to establish shell subsidiaries or move themselves to areas with reduced or nil taxation levels relative to typical international taxation. This creates a situation of tax competition among governments. Different jurisdictions tend to be havens for different types of taxes and for different categories of people or companies. States that are sovereign or self-governing under international law have theoretically unlimited powers to enact tax laws affecting their territories, unless limited by previous international treaties. Definition. The Organization for Economic Cooperation and Development, OECD, identifies three key factors in considering whether a jurisdiction is a tax haven. A. Nil or only nominal taxes. Tax havens impose nil or only nominal taxes, generally or in specific circumstances, and offer themselves or are perceived to offer themselves as a place to be used by non-residents to escape high taxes in their country of residence. B. Protection of personal financial information. Tax havens typically have law or administrative practices under which businesses and individuals can benefit from strict rules and other protections against scrutiny by foreign tax authorities. This prevents the transmission of information about taxpayers who are benefiting from the low tax jurisdiction. C. Lack of transparency. A lack of transparency is the operation of the legislation, a lack of transparency in the operation of the legislative, legal or administrative provision is another factor used to identify tax haven. The OECD is concerned that laws should be applied openly and consistently, and that information needed by foreign tax authorities to determine a taxpayer's situation is available. Lack of transparency in one country can make it difficult, if not impossible, for other tax authorities to apply their law effectively. Secret rulings, negotiated tax rates, or other practices that fail to apply the law openly and consistently are examples of a lack of transparency. Limited regulatory supervision or a government lack of legal access to financial records are contributing factors. Classification. Corporations, in order to achieve effective tax avoidance, use multiple types of tax havens. 3 types of tax havens form a Dutch sandwich. A. Primary tax haven. The location where financial capital winds up. Subsidiary shell companies there have obtained rights to collect profits from corporate intellectual property by transfers from their parents. B. Semi-tax haven. Locations that produce goods for sale primarily outside of their territorial boundaries and have flexible regulation to encourage job growth, such as free trade zones, territorial only taxation, and similar inducements. C. Conduit tax havens. Locations where income from sales primarily made outside their boundaries is collected and then distributed. Semi-tax havens are reimbursed for actual product costs, perhaps with a commodity markup. The remaining profits are transferred to the primary tax haven because it holds rights to profits due to the corporate IP, that is corporate intellectual property. By matching outflow to income, they do not retain capital and their role, while crucial, remains invisible. Large multinational corporations may have dozens of such tax haven entities interacting with each other. Each haven can claim that it does not satisfy definitions that attempt to place all tax havens into a single class. Even increased transparency does not change the effectiveness of corporate tax avoidance. Examples. Research has suggested that roughly 15% of the countries in the world are tax havens, that these countries tend to be small and affluent, and that better governed and regulated countries are more likely to become tax havens, and are more likely to be successful if they become tax havens. Switzerland, Luxembourg, primarily a conduit tax haven. Other sovereign countries that have such low tax rates and lax regulation that they can be considered semi-tax haven are Ireland, Netherlands, primarily a conduit tax haven. Non-sovereign jurisdictions commonly labeled as tax haven include Jersey, Isle of Man, British Overseas Territory, Bermuda, British Virgin Islands, Cayman Islands, Delaware, United States, Puerto Rico, United States.